SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF BAFFI Bocconi e-lecture on key takeaways from the ECB May 2024 Financial Stability Review. With euro area inflation steadily declining and ECB interest rates being widely expected to be lowered starting from mid-2024, euro area financial vulnerabilities appear to be muted. Markets appear exceptionally relaxed about risks. Yet, some observers are raising concerns about high government and private debt and debt servicing costs, not only in the euro area, but even in the US. We're all worried about the fallout from potential escalation of geopolitical conflict. How about devastating cyber attacks, potentially but not necessarily linked to geopolitical conflict? How much of the deflation of real estate overvaluations is yet to come? What if stock market investors' optimism reversed? In a more medium-term perspective, what additional risks might the accelerating rollout of AI in the financial industry bring? How about risks from climate change given slow progress on climate protection? Now, fortunately, the ECB condenses its expertise twice a year in a published document, the Financial Stability Review. The latest ECB FSR was released this morning. We're privileged to have the ECB's leading mind behind the FSR with us today to present key findings. A warm welcome to John Fell, Deputy Director General, Macroprudential Policy and Financial Stability at the ECB, and John is also a SUERF Fellow. John's presentation will be followed by comments and further inputs by Fatima, Silva, Head of Macroprudential Policy Division in the Financial Stability Department of the Banco de Portugal. A heartfelt welcome to Fatima as well. Without further ado, over to you, John.
So thanks a lot to you, Ernest. Thanks a lot for that very kind introduction, and thanks a lot to the SUERF board for inviting us once again to share our findings with the SUERF community. I think it's going to be a particular pleasure today to also be on the panel with Fatima Silva, who is an old friend going back maybe 20 years or so, I suppose. I always say this, but I still think it's worth repeating. And when I say we, I'm speaking here on behalf of the whole team. We really value these opportunities to share our findings, and of course, we're very keen to receive feedback. We're going to get some feedback from Fatima, but also, I hope we will hear from colleagues who are on the webcast. We know readers of the episode come from diverse backgrounds, and that could be policymakers, it can be professionals from the financial industry, or even academia. And I think this is what makes these events relatively unique. Before I start, I would like to make a plug and to show how seriously we take feedback. We have decided this time to launch a readership survey on our financial stability review. It can be very easily found on the website. If you just Google Financial Stability Review, ECB May 2024, you will find it at the top of the page. And I promise you, it's a very short survey. But we're really keen to hear, whether we are meeting the needs, desires, wants of our readers. So I think we can go to the next slide. And I'm going to start by saying that preparing this issue of the Financial Stability Review was a bit more challenging than usual. The reason I'm saying that is because many developments that have transpired since the November issue can be viewed positively from a financial stability perspective, but others have been downright negative. Now, maybe just a little bit of speaking about the core purpose of why we write financial stability reviews. It's because we want to highlight sources of risk and vulnerability, with the intention of informing macroprudential policy, which we have responsibility for at the ECB, and also to influence behavior in the financial industry. And we also think that our analysis can only be credible if we are not perceived as being the boy who cried wolf once too many times. So that means that we do face over time a trade-off between so-called type 1 and type 2 errors. And arguably, this trade-off usually tends to get a bit trickier around turning points, just as it is, I think, for people who are doing business cycle forecasting. So what has been positive? Well, you can see there on the left, euro area inflation has come down more or less euro area inflation is more or less continuously surprised on the downside. It's now expected to reach 2% sooner than we previously thought. Meanwhile, euro area growth expectations were revised down, but economic surprises have been positive. And the consensus view now, is that a euro area-wide recession will be avoided. And so we have expectations of a soft landing firmly entrenched now. Markets are expecting the ECB to lower rates before the Fed. And I think this chart is maybe helpful in explaining why markets are thinking this way now. So rather than a soft landing with both US growth and inflation coming in ahead of expectations, notwithstanding the recent inflation numbers in the US, the dynamics, you could say, you could caricature them to say that they resemble more like a missed approach in the US, or perhaps even a postponed landing. Now, some analysts are now saying that the Fed might not cut at all this year, but different to what might have been feared, financial markets have remained resilient. That's the good news. So what is there to be gloomy about? Now, while vulnerabilities might be easing, much of our financial stability discussions these days are preoccupied with possible shocks, things that could go wrong. And there's unfortunately no shortage of possibilities of things that could go wrong. They include a macroeconomic outlook, which remains uncertain, and inflation, which is lower, but not yet low enough, leaving room for disappointments. Then there is the big unknown, geopolitical risks, which have the potential to derail improving macro-financial conditions. We've already seen this with, for instance, the invasion of Ukraine. Now, given its relevance, the FSR this time contains a special feature on the topic of geopolitical risk. I'm not going to have time to get into that in detail, but I would just draw readers' attention to that. So now if I go to the next slide, overall, weighing the positives against the negatives, our assessment is that financial stability vulnerabilities have eased, but this more positive outlook is fragile, and it's fragile for several reasons. First, we think the resilience of cohorts of so-called vulnerable corporates, households, and sovereigns could yet be tested by rising debt servicing costs. Well, the downturn in the property market, and here especially the commercial property market, is a source of concern. It's posing challenges for real estate firms. Second, banks have remained resilient, and in the sense that capital and liquidity buffers are large, and profitability has been strong. But going forward, weaker asset quality, higher funding costs, and lower income on, for instance, variable rate loans, we think it could weigh on future profitability. And I think the market valuations for banks are telling us that. Third, our prior is that banks are priced for is that markets are priced for perfection, leaving little room for surprises. So we think this makes them more prone to what we call outsized reactions should economic outcomes disappoint, fall short of expectations. And added to this, persistent liquidity vulnerabilities in the non-bank financial sector renders the non-bank financial institution sector, that renders this sector pro-cyclical, making it a shock amplifier. This is something that I've had in presentations before. The rest of the presentation is going to be organized around these three themes. So if we move to the first one, the next slide, indications that the euro area financial cycle has gone through marked contraction are plentiful. That this has happened without triggering a financial crisis is a big positive. But a key question is why? Why didn't we have a financial crisis given the extent of the contraction in the financial cycle? And I think one answer seems to be resilience, especially resilience of households and firms. And there are many dimensions to this resilience. I mean, you can look at it from price, quantity dimensions, stock flow aspects. If you see on the left, firms and households are less indebted today than they were on the eve of the pandemic. There was a blip up in all of them, the yellow bars, but if you compare the blue bars with the red bars, the eve of the pandemic is the blue, the red is roughly where we are now. We can see that we have, there's been the household and firms have less debt than they had then. And of course, this is partly thanks, as you can see, also to a transfer of risk to the sovereign sector, where actually the red bar is higher than the blue bar. Second, the composition of debt has changed, and the way in which it has changed is firms and households locked in low interest rates during the pandemic at long maturities, and that explains why lending rates on outstanding loans have been rising more gradually than headline rates, the ones that you read in the newspaper, on new loans. You can see the divergence there on the right-hand side. Now, arguably, financial system resilience was never really put to the test in this interest rate cycle because non-financial sector balance sheets have, for the most part, been resilient to sharp interest rate hikes. In turn, this together with other factors such as, I'm talking about the corporate resilience, we've had corporate pricing power, lags and wage increases and so on, has ensured that the resilience of corporate profitability has been maintained for most sectors, and that has allowed a hoarding of labor when economic activity weakened. Now, the flip side of this mutually enforcing resilience between households and firms is that it could yet prove vulnerable to a reversal. Among the negatives that could undo it, and don't forget, this is not central scenario. We're just thinking about things that could go wrong. It includes the resetting of rates on fixed-term loans at higher levels, and then refinancings in the corporate bond market, and that could, potentially squeeze net income of firms. Now, if we go to the next slide, looking briefly at each sector in turn, and we start with household balance sheets. The headline positive here is signs of stabilization in housing markets. Prices have stopped falling, or as you can see on the chart on the left, they've even started rising in some countries again. Now, although cross-country situations are different, broadly speaking, different to what we might have feared. Let's say it wasn't our central scenario, but we thought there was a risk of disorderly correction in house prices. We've had orderly house price decline, and that's lowered overvaluation measures. And that in turn has lowered tail risk, downside tail risk in housing markets. Now, reasons for why this has happened is it can be found in survey indicators, including consumer confidence and expectations of own financial situation. And as you can see there on the right, now for the first time in 2 years, and this is from the ECB Bank Lending Survey, for the first time in 2 years, banks are expecting a net positive change in demand for mortgages. Now, the chart also shows that the main reason for that is expectations that lower interest rates will boost housing affordability going forward. Still, there are negatives, with housing not being especially affordable in some countries, while some markets are still showing signs of overvaluation as well. And of course, now we've also got some rebounds going on. So all in all, so long as labour market resilience is maintained, and that has been a very important factor for overall resilience, better economic prospects together with expectations of easier financing conditions should avert risks of disorderly correction in housing markets. Now we go to the next. That's the general picture for households, but we have identified some vulnerable cohorts. You can see on the left, expectations of payment difficulties have spiked for lower income households. Challenges are going to be most acute for households who have funded their house purchases on floating rate terms. Now, notwithstanding the positives that I mentioned earlier of resilience in the corporate sector to slower growth and higher interest rates, we also see vulnerabilities at the sectoral level. So among large firms, interest coverage ratios. So this is a measure of the ability of firms to meet interest payments out of their current earnings. They've declined across the board since end 2019 as in interest rate sensitive sectors in particular, and in sectors that have been adversely affected by weaker demand. Now, the sectors of greatest concern are those with low and declining interest coverage ratios, and you can see that's the case for most. But one where you also see a rundown in cash balances, so that's also shown on the chart. When you see cash flow declining like that, it could be a sign that cash flow is not sufficient to cover interest expenses, forcing earnings are not sufficient to cover interest rate expenses, forcing those firms to raise their savings, so to speak, to pay their debts, to service their debts. Now, real estate firms stand out here. It's on the far right, but other sectors you can see are depleting their cash balances as well. Now we go to the next slide and digging a bit deeper into commercial real estate. The outlook here has continued to deteriorate. And actually, I mean, for each, I've been emphasizing negatives and positives up to now, but I think it's a lot harder here to find positives. Vacancy rates, a key driver of commercial real estate values, have risen significantly since the pandemic, with no concrete sign of improvement. And expectations for rent growth reflect this, with even prime market rents expected to grow. You can see it's positive for prime markets in Europe, but look at the numbers. They're very small, and they're lower than the expected rate of inflation. At the same time, transactions activity has dried up. Now, a paucity of data on actual transactions actually makes empirical modeling very challenging. What does it mean if we don't have any transactions going on? What does it mean about future developments and prices? And you could look at this from a glass half full, glass half empty perspective, but our market intelligence here suggests that depressed transactions activity might yet prove to be the calm before the storm. So a trigger for which could be vulnerable property markets failing to refinance their debt, forcing them then to fire sale assets so that they can make good on debts. Now, these vulnerabilities are apparent in the financial performance of real estate firms. They're on the right. So these are firms that own and rent commercial properties, and you can see that median profit margins are closing in on zero. And the share of loss-making firms, so that's the blue line chart, it's in the total, it surged to 70% last year. So 70% of firms that own or rent commercial properties in Europe were losing money last year. Now, that said, and maybe this is a cautious positive, but I should also say that, I mean, we're speaking here mostly of office commercial real estate. It's not across the board. There are some parts of the commercial real estate sector, logistics, data centers, and so on, hotels even, where the situation is more positive. But this is I'm speaking here primarily of offices, which is a very big segment of the market. Now, that said, and maybe this is a cautious positive, our assessment continues to be that a commercial property crisis would not on its own, if it were to materialize, be sufficient to cause a banking crisis. And the reason for that is because actually the direct exposures of banks to commercial property is not very large. It's about 5% of total assets, with heterogeneity across though, and there will be pockets of vulnerability. Now, if we go to the next slide, and before I conclude on the non-financial sectors, as seen on the left here, sovereign risk has continued to ease. It's not been prominent in financial market developments for some time. But the positives here include rating outlooks that have mostly improved, spreads which have mostly narrowed, and I'm speaking here compared to the last episode. And that's due in part to the continued post-pandemic decline of debt to GDP ratios, which was driven first by the economic growth rebound and then by inflation. And I think the economic growth rebound has been, we see some heterogeneity there that it's benefited. The countries that had difficulties with sovereign debt in the past have benefited from this factor more than average. And then, as I said, by inflation. Now, both of these effects are, however, wearing off, with debt to GDP ratios stabilizing at high levels in some countries. And that leaves them vulnerable to domestic or even to global shocks, because we've also had very little increase in US government bonds. We've had some, but I mean, it's not been, it could have been, perhaps we didn't exclude the possibility of sharper rises in long-term interest rates in the US. And I think, but we can expect a continued rise of US government debt. And regardless, I think, of which candidate wins the election, now this doesn't actually feature too prominently in the episode, but I say it because you might get questions about it. It remains on our radar as a longer-term source of risk. So it's certainly not something that we're not keeping an eye on. We go to the next slide, and turning to the second theme and the challenges that lie ahead for banks. For the full year of 2023, last year, the return on equity of euro area banks was recorded at 9.3%. That's a level that has not been reached in a decade and a half before the global financial crisis. It's another positive for financial stability, and the reasons are well known, being largely driven by steady improvement in net interest margins once the tightening of monetary policy got underway. Now, on the basis of This is based on supervisory data, which is very high coverage for the sector. We've been, we're more or less calling a turning point in banking profitability. Now, that assessment could be questioned, but we don't have all the data yet to confirm. It could be questioned by recent earnings reports of some publicly traded banks in Europe that have had even stronger than the 9.3 that I mentioned. But if interest rates have peaked, a mild reduction in profitability, as is depicted in the plot of analyst expectations there on the left, seems inevitable. I mean, it's going to be soon. It's within the horizon of our risk analysis. Now, what this suggests, we also see bank valuations improving, and they have improved, significantly since the start of the year. It's the blue line there, price book ratios for European banks, together with some global peers. European banks are in the bottom grouping, together with the Japanese and the UK banks, and they all have what I would call sub-unity valuations, and so that means that the market perceives these banking sectors as being value destructive at the margin. They're not earning their cost of equity. So that's something to watch longer term. Now we go to the next slide, and the resilience of corporate and household sector balance sheets has been mirrored in banks' asset quality. Now here, for example, NPL ratios have remained at historically low levels, but we are seeing some signs of deterioration, and that's especially for commercial real estate, which shouldn't be a surprise given what I already said, where net inflows turned positive last year. But we also see some vulnerabilities starting to crack, starting to show in consumer credit, and also loans to so-called micro firms, so very, very, very small firms. Just as we've identified pockets of vulnerability in the household and corporate sectors, banks may yet face the risk of higher provisioning costs if these non-financial sector vulnerabilities are exposed, not least because there is high uncertainty about whether the collateral values behind commercial real estate loans accurately reflect market realities. Because if we don't have much actual transactions taking place in the market, it makes it very hard to value those assets, and so there will be uncertainty about how valuable those assets are, and whether the haircuts that were used to set the collateral levels are still reasonable, or whether it poses risks for banks going forward. Now, in addition to this, as I already mentioned, banks are likely to feel pressures on net interest margins, both from reduced income on floating rate loans and on the cost of deposit funding as interest rates pass through to deposits. Now we go to the next slide, to the third and final theme. These two charts show the financial market exuberance is back. Question, of course, is whether it's rational exuberance or irrational exuberance. On the left, stock markets have reached record highs, and credit spreads are back to pre-pandemic lows. For quite some time, the commonly accepted narrative for this exuberance was a better growth outlook together with an inflation outlook that had improved sufficiently to justify expectations of a dramatic and a synchronized pivot by mature economy central banks this summer. Of course, those expectations have changed, especially for the US. Still, the US rally proved resilient to a scaling back of market expectations for Fed rate cuts. But maybe even more impressive on the chart on the right is the 64% year-to-date return on crypto assets. That's, by the way, year-to-date to the cutoff date of the publication of the FSR. It's not the most recent number. Technical factors related to constraints on Bitcoin supply is a common narrative here, but the market has also benefited from crypto ETFs, and no doubt fear of missing out has been a factor. So, this could be some hints at irrational exuberance. Now, other risky asset markets, such as private equity, have also been booming. Now, in this vein, we do have a special feature on private markets this time as well, and this finds that risks in euro area private equity, while they seem to be contained, there are concerns about the potential for hidden losses. And the reason why we say that is because the valuation models, they may, valuations may be based on market-based rather than actual transacted prices. This is what, if there are no transactions taking place, you need something to come up with a current value, and often you're going to have a model for that. Or it could be higher than normal credit risk in the assets that private equity invests in. If we go to the next slide, one market pricing anomaly that we've taken a deeper look at in box 2 of the FSR is on recent trends and implied volatility in equity markets. It's a bit technical now, this topic, but it does have relevance for financial stability. We could take it, taking a very superficial look at it, we could take a positive from this and see it as an indication of perceptions of low risk. But in our assessment, it appears too low. And the reason why we think it's too low is not only because of continuing uncertainty about the interest rate outlook, but also because it seems absolutely unperturbed by heightened geopolitical risk. And we know that this is a lot higher than it was 6 months ago. Now, the box discusses a range of factors that might explain this low volatility levels, and we can find some fundamental factors. But there's no time to go through it now, but just to say that we think it poses risks for market functioning, because it can lead to incentives for excessive leverage in derivatives markets, because it lowers margin requirements on derivatives contracts, and through risk parity strategies, for example, which could by virtue of their rule-based operationalization lead to an overweighting of overvalued equity when you have very low volatility. Furthermore, since equity volatility is a determinant of credit spreads, it can also lead to and create feedback loops with credit markets. And all of this is to say that a sudden rise of equity market volatility could have far-reaching impacts, including on credit markets. Now, before I get to the policy recommendations in the next slide, if we just go to the next slide, this is a reminder of the sources of financial stability concerns arising from the non-bank financial sector, our nbfi, as we call it for short. As most investors, especially retail, but not only, empirical work shows that they tend to behave in a pro-cyclical way. What does that mean? They buy when others are buying, and they sell when others are selling. And that results in, when you have shocks to market valuations, that often triggers increases in investment fund outflows, our margin calls on derivative exposures. Now, that would be fine. Well, it would be fine, except that we have, when we have low liquid asset holdings in those funds and significant liquidity mismatches in some types of them. You can see it there on the left-hand side, especially real estate funds, but also bond funds. That can result in, if there is, if investors are asking for their capital back, and the fund doesn't have it, it might be forced to sell assets. That can result in forced asset sales. That can negatively affect wider financial stability, because that can amplify market disturbances. Now, going to the next slide on policy recommendations. For macroprudential policy this time, we're calling for the maintenance of current settings for capital buffer requirements and borrower-based measures to ensure resilience against all these tail risks that I've mentioned. We're also calling for enhancing macroprudential policy space in the medium term to ensure that there is a sufficient amount of releasable capital in the banking system that would be available if and when it was needed. Now, we make a number of other pleas in the FSR this time, including supporting capital markets union objectives through ensuring that the nbfi sector is resilient and stable. We think that having a framework for a robust framework for macroprudential policy for the non-bank financial sector is a complementary policy objective to the one of developing a capital markets union. Now we go to the final slide and wrap up. Our assessment is that sources of risk and vulnerability for the financial stability outlook have eased, but the outlook is fragile. I could put that into more precise technical language that I'm sure many members of this community on this webinar will get, I hope. The central scenario has improved, but tail risks have increased to the downside. So while we still think that the deliberate efforts that have been taken to fortify capital and liquidity buffers within the banking system have positioned it well to face higher risks, we really think there is no room for complacency, because we still don't have a comprehensive framework for macroprudential policy for nbfi, and we do see vulnerabilities there.
Thank you very much, John. Now, before I release you and before you stop sharing the slides, I had a look at the additional slides, which cover three, special features. Would it be possible that you briefly touch upon these as well? Because I think they are very relevant and interesting.
Okay. Yeah. I mean, if Jonas, are you able to continue? So, I mean, we have a special feature on geopolitical risk, and I mean that I think it's one of the most comprehensive overviews of empirical analysis on the different channels through which geopolitical risk can affect financial stability in the euro area. Some of it is there. We know it has particular negative impacts on volatility that can impact risk aversion, and it can lead to stresses in financial markets. We've also found that investment funds are especially vulnerable to geopolitical risk, because people may want their money back. It's almost the equivalent of a bank run, but not on the same scale. That people may, for precautionary reasons or whatever, want their money back when geopolitical risk is high. Maybe they need the money back, and so you get these stresses that I was talking about earlier. And then a third finding is that we find that weakly capitalized and less profitable banks tend to be more strongly affected by rising geopolitical risk. So, for example, their cost of equity can rise by more than is the case for banks that are better capitalized and more profitable. We go to the next slide, and the artificial intelligence one. Here, by the way, a plug for we did a podcast on the financial stability review, and there will be a lot in that tomorrow. It's released at 9 o'clock tomorrow morning, where we speak in some depth about artificial intelligence and how it's affecting financial stability. We put a lot of effort into maybe two things that are important: trying to distinguish what is old wine in new bottles, so to speak. Are there risks that artificial intelligence just maybe it speeds up contagion, makes contagion easier, but it's not really a new risk. It's not a new vulnerability. It's just an old vulnerability or an old risk that moves a bit faster. So we really try to focus on what are the new things about AI. The second, I think is important. There's a lot of emphasis in this special feature on also the benefits, because as I say on the podcast, our financial stability review is not a financial instability review. And technological advances we know can be beneficial for financial stability. But one point that we make, where there could be concerns, we've seen it already in the tech industry more generally, that if you get a lot of concentration of suppliers, that can create vulnerabilities if you have many institutions in the financial system all dependent on the same suppliers. And there are some other some points here. So, for example, operational cyber risk, they would be, if they were to crystallize and everybody depended on the same supplier, then that could be a big problem. We go to the last slide, and that is the private markets. I mean, but I already mentioned some of the points. I mean, I think we found the markets have in Europe, the private markets have grown rapidly. We think that they have a place to provide benefits to the real economy, but we have some concerns about the opacity, the resilience, what I call about slowness to revalue assets, whether the mark-to-market that we see a lot in other parts of the financial sector doesn't seem to work at the same speed in this sector, and we also see some exposures of the industry to more highly indebted firms. It's there on the middle chart. You can see, for example, this is I mentioned the interest coverage ratio already. So you've got private equity and public equity. So just comparing the interest coverage ratios that are in publicly quoted equity, so that's the second from left bar, together with the euro area private equity, you can see that interest coverage ratios are much lower for the private markets than they are for the public ones. And that means that those are sectors that are more vulnerable to interest rate shocks. So, but there's more in it. I wouldn't be able to do justice to it. But thanks a lot for asking. Thanks a lot for asking, Ernest.
Thank you, John. This was extremely interesting as well. Now over to Fatima for your comments.
So I hope that you can see my presentation full screen. Okay, so good afternoon, everyone. First of all, let me thank you, Ernest and SUERF, for the opportunity and the invitation for discussing the main conclusions of FSR. And I would also like to thank John and his team for the excellent and interest work with a great analytical insights and appropriate policy message. And let me also just mention the usual professional disclaimers. So these are my views and not those of the Bank of Portugal or the Euro system or any policy committee. So my talk today is going to be around two major points. The first one are the main key takeaways from the Financial Stability Review. And here I would like to provide with you some information regarding our banking system that would allow to support the main risk assessment that is included in the FSR that Jean just described. Then my second theme is my background, my professional background. I would like to discuss a little more how effective has macroprudential policy been and what more can we do going forward in regarding the policy measures. So start by the key takeaways. I think indeed the main message is that financial stability vulnerabilities in the euro area eased, but the outlook remains fragile. And I totally agree with the assessment, and I think it's a quite well-balanced analysis that is provided. The report indeed highlights the positive inflation, the positive evolution in inflation towards this medium-term objective, together with an improvement in the economic outlook. However, the pass-through of higher interest rates to the private sector might be not still complete, and it leads the sectoral vulnerable to adverse shocks. At the same time, public debt is above pre-pandemic levels, while some correction in house and commercial real estate markets is already there and is challenging real estate companies. Even though the correction in house and commercial real estate market has been so far orderly, we still can observe some downside risks in some countries. So here there is some heterogeneity among euro area countries. In this framework or in this environment, banks have remained resilient, but their profits are likely to decline going forward. And as John just showed, the FSR has a lot of insights regarding the non-banks. There also might be some challenge and some risks there, especially in the non-banks entities that have lower buffer liquidity buffers. So as John just mentioned, the tail risks have increased, the downside tail risks have increased, and I have here a point saying that the likelihood of materialization of that tail events and the financial stability points a lot of potential tail events like the geopolitical risk, the policy uncertainty, the shift in the financial market risk aversion, deviation of inflation from the expected path, and economic and financial fragmentation appears to increase, and that is exactly the problem. Going forward, authorities have the challenge to preserve the resilience of the banking sector and also to implement a comprehensive set of policy measures to enhance the resilience of non-banks. Now, trying to corroborate this risk assessment with our own evidence. Here we can say that Portuguese banking sector is now resilient. It has been through a lot of changes during the last couple of years, and we can say that it is resilient, and this resilience is underpinned by strong capital and liquidity positions. So if you look at these charts, you can see here that on your left-hand side, that total own funds ratio, so the capital ratio of the banks, has been steadily increasing, and we almost reach right now 20%. And the profitability, if you now turn to the right-hand side, is at historical high levels. The return on assets was significantly higher than the euro area average, and the cost to income is continuing its downward trend, contrary to euro area average. Banks' NPL ratio net of impairments stabilized around 1.2%, and loan loss charge has slightly increased, as also John mentioned that is happening to other euro area countries. Now, of course, this positive outlook, we still can see some risks coming. And these risks can indeed be connected to higher funding costs or some deterioration in asset quality, or even lower income from floating rate loans, because the credit is mute and we expect the interest rates to go down. Also, regarding the non-financial corporations and households, so the main counterparts of the banking sector, they show resilience, and that can be indeed can be seen by the two charts that we have here, in which we can see that the levels of leverage and indebtedness in both sectors have been decreasing and are now standing below the euro area average. But the average also might have other realities, and we can see during the last couple of months that there was a slight increase in most vulnerable firms, and also the households with a ratio, a loan to service ratio in relation to income above 50% has been slightly increased. And so this means that there are still some pockets of vulnerabilities that we should closely monitor. So I think that our conclusions also are in line with ones that John just presented. Now, discussing a little more what type of policy can be implemented and what more can we do, here I think that the ECB puts forward a very comprehensive set of policies. First of all, and regarding the banking sector. So the ECB acknowledged that and advised that at this point in time, we should preserve the resilience of the banking sector by even maintain or even increase the resiliable macroprudential capital buffers. And in the medium term, we should enhance the macroprudential space. Indeed, I agree with this message, because even though the financial cycle has turned down and is still its downward going on, even though it has been orderly, the question is, how could we indeed keep the resilience, the banking sector as resilient, and in a context in which we are going to face higher financial conditions or even higher uncertainty? And I believe that the only way going forward is indeed to increase or to maintain the capital buffers, namely the ones that are releasable. That means that we are able to release these buffers when a shock materializes. And why is that? Is because we still have macro-financial favorable conditions, and we still can see that our banking system has capital headroom and some good profitability. And that was exactly what we did here in Central Bank at the last quarter of 2023. We introduced a sectoral systemic risk buffer that was aimed to increase the resilience of the banking sector due to whenever there is a potential systemic risk that was connected maybe with the residential real estate market. And we are talking here potentially of events regarding to the downturn in financial cycle or to an expected significant correction in residential real sector prices. At that point in time, we did assess that impact on the cost of loans would be contained, and also the impact on the economic activity. And why was that? Because we indeed assessed that level of banks' capital headroom and the profitability could indeed absorb this increase in capital. Now, the second measure that the FSR put forward is that this set of capital measures should be complemented with the borrow-based measures. What are borrow-based measures? Borrow-based measures are measures that we apply whenever, or the banks apply whenever they have to concede or grant a credit to a household. Namely, for instance, the banks have a certain limit in relation to the total credit in relation to the value of the collateral. I'm sorry. So the ECB acknowledged that this type of borrow-based measures should be considered as structural backstops and should indeed ensure sound lending standards. And these borrow-based measures should not be changed because they are structural according to the position in financial cycle. Here in Portugal, we have implemented 6 years ago in 2018 a comprehensive set of borrow-based measures. And since then, we indeed have seen a change in the risk profile, an improvement in the risk profile of our borrowers. These measures were intended to increase the resilience of the banking system and households. However, we think that these measures might need in their design and calibration to consider some flexibility via the inclusion of exemptions or other features that would allow the national authorities to adjust the calibration of certain parameters in case that monetary policies change, or in the case that we are faced with an unexpected shock, or even in case that the mortgage market would change. And exactly it was what we did also in the last quarter of last year. We indeed changed slightly the shock that we consider in the debt service ratio, so the total debt that borrower has to pay in relation to the income. So we decreased this type of shock. It was supposed to be 300 points, and then we decreased to 1.5. And why was that? It was because the interest rates have already increased substantially, and we were seeing that this measure, like it was designed, it was too restrictive. Moving forward, we think that we agree with the ECB when he says that the bank's framework should be enhanced, and this, of course, we should always implement the Basel capital and liquidity standards. We should have flexibility in our toolkits to activate this type of capital buffers early in the financial cycle, and should promote consistency in the use of different capital buffers across euro area countries. I think that we also support, or I support, the development of guidelines, and those guidelines should in any case preserve some national flexibility. And what is also quite important in this area is to stress the cooperation between macroprudential authorities and other authorities, namely the resolution and the micro authorities, especially when we are facing a systemic risk shock. Now, what more can we do? And here the ECB puts forward that a comprehensive set of policies for the non-bank sector. I think that this is the time exactly that we should go on and develop this macroprudential framework. And there are some features that this macroprudential framework should have embedded. Namely, it should be an holistic perspective. It should build the resilience ex ante and not only rely on exposed measures. It should have an entity and activity base, and also it should develop flexible measures that we can change according to the risks that are involving. And of course, in order to avoid regulatory arbitrage, or in order to avoid financial fragmentation in cross-border exposures, or even to get an increasing risk-taking due to the interdependence between the banks and non-banks, it should be aligned with international principles. Whenever any measure should be designed or calibrated, it should be subject to a net benefit analysis that would take into account not only the costs, but also the benefits. And the benefits are if it is effective or if it is feasible. I totally agree that we should also be in line and develop the Capital Markets Union as a source of diversification of the funding and also of the risk-taking, as John just mentioned. And finally, I think it's utmost that whenever we design this type of regulation, we take into account that we need a sector that is profitable or have sustained profitability going forward. And of course, cooperation among different authorities, if it is needed in the banking sector, I here consider it to be even more desirable because it's a market where we have very cross-border movements of capital and cross-border exposures. Now, I thought about maybe 3 potential topics that could be addressed in next financial stability review. I think that John has already discussed soft landing versus hard landing. So so far we are seeing a slow economic growth, but it's still positive. Interest rates and inflation are on a downward path, but there are still a lot of uncertainties, geopolitical uncertainties, other types of uncertainties that indeed could jeopardize these orderly corrections that we are perceiving. So the question here is that this time, did we indeed succeed having a soft landing, or are we not going to succeed and have a major recession with a hard landing? What threats can indeed lead us to deviate from this soft landing and going to a hard landing? The other question that also John talked about it in the presentation is that we are receiving some, let's call, divergencing in monetary policy stance across US and euro area. And here, I think that going forward in the next couple of months, we are going to discuss what is the impact of this in financial stability, namely in exchange rate movements or even in capital markets where we have a very compressed volatility. And finally, the last question is that in this framework, or in this environment, how could banks and other financial intermediates maintain the adequate profitability and resilience levels going forward? Namely, take into account that we, and John addressed that in the presentation, the huge amount of cyber attacks, also the digital area that we are facing with AI there and coming into play, and coming new players into the market, like the credit private markets, or even if we consider that still the financial sector has to face and has to invest in the transition to the more green economy. And I would leave it here for the time being.
Thank you very much, Fatima, for your excellent and rich comments. And of course, also for your suggestions for homework for John for the next 6 months. I'm sure homework ideas will also come from other sides, so a lot of work is guaranteed for the next month. John, do you want to react immediately to Fatima's comments?
I think, yeah, I mean, I think these are great points, Fatima, and I think, yeah, I agree. Maybe, I mean, the first one, I think, yeah, I mean, that we can be fairly sure that we will have that. But I think this issue of diverging monetary policy, if we get it, and you know, we lower rates, and in the US rates remain where they are, I mean, we're going to have, well, I think we already see also some, you know, developments in the currency markets, which we haven't really in the past mentioned as a source of financial instability. But I mean, when you look at, you know, all the factors of what's happening in the supply-demand balance in fixed income markets globally, with fiscal expansion, monetary contraction, and then differential terms of trade shocks in the US, where, you know, the US has actually benefited from this energy shock. Europe has not. You know, so there's a lot going in the direction of divergence, as you rightly say, Fatima. So I think we need to look at that. I think also I agree with you on the profitability. It's always hard. I mean, we are public sector authorities. We are not private sector individuals, but we see the importance of having profitable financial institutions, and to explain it. It's not always so easy to explain why we need it. I mean, I think the obvious one is that this is where resilience comes from. I mean, banks will build their capital buffers from their earnings, the profitability. Retained earnings creates capital. It's the cheapest form of capital, quite frankly. You know, it saves them from having to go to the market. So this is, you start taxing it away, as some authorities have tried to do. You know, that's actually counterproductive from the point of view of the stability of the banking system. But I think there's other things that I think people miss. You know, why is profitability? Why should we be worried about profitability declining now in the banking sector? I mean, when you think about, you know, business in general, where do businesses cut costs? when they are going through more difficult times. They cut in things like advertising, but they also cut in places like IT security. So, you know, when banks are less profitable, it means that their ability to invest in IT and remain competitive in international global marketplace is impaired. But it also means that you can see it even in the performance of some of the largest cyber security firms in the world now. The revenues declined or came in lower than markets might have been expecting because of cost cutting in the corporate sector and elsewhere. And that means that if you have less profitability, you have higher cyber risk. And I think this is not a time that we want cyber risk in the financial industry in Europe. I could go on, but these are examples that I hope are helpful in explaining why we need a profitable banking sector.
Thank you, John. We have only 3 minutes left, and I actually have quite a few questions on my table, and I cannot do justice to them all. Maybe I just pick out one question, and that one is, how does a fall in inflation, which is happening right now, influence potentially the financial stability outlook? How to view this in conjunction with the outlook for interest rates? So of course there is the the impact on the debtors, on the debt servicing, on the inflation tax and so on. So has there been any thinking about this?
I mean, I can react very in view of the time. I mean, just say overall, it's positive for financial stability. It means that interest rate, lower inflation means that the ability of the central bank to lower interest rates is increased, and debt servicing is going to be lower. There are other nuances, but there isn't really time to go through them. There are winners and losers in interest rate changes as well, but savers and borrowers, all of this. But on average, lower rates are good for financial stability. That's what the models tell us.
And then, if I use the remaining minute that we have, there's a question by Albert Schubert, who you all know.
I saw the question.
Says, yes. So, which wishes to Santa Claus would you have, John, to further improve your FSR? I mean, it's already extremely rich.
Delighted to see Errol's name, old colleague from the ECB. I mean, very quick, commercial real estate, I mentioned it already. We have a paucity of data there. We have nothing like hedonic price indices for commercial real estate in Europe to compare two similar properties in two different places or over time. Private markets as well is an area where, I mean, but we have some private sector data providers there, but that's another area where. But I mean, maybe I make the more general point, and Fatima would know this. I mean, being in the financial stability business for a long time, part of the work is working in areas that are not well measured. So we often confront issues of paucity of data. It doesn't mean that we don't have information, because then we rely on market intelligence. We speak to people in the industry, and we get a sense for qualitatively what is happening. So yeah, I mean, it's not ideal. We would prefer data, because then we can build models. But still, it doesn't mean that we're completely in the dark.
Excellent. I think it is time to conclude. Thank you very much, John and Fatima, for your excellent presentations and for the rich discussion. This concludes our SUERF BAFFI Bocconi e-lecture on key takeaways for the May 2024 FSR. Thanks to all for your interest and for participating. And I hope we see each other again in roughly 6 months for the next edition of the FSR.
If you invite us, we'll be there, Ernest. Thanks a lot.
We will. Thank you. Bye-bye. Thank you.
Thank you.
Bye-bye.
Bye.